In the spring of 2026, an unprecedented financial disaster swept across the globe like a hurricane. The bubble in the cryptocurrency market burst suddenly, wiping out trillions of dollars in digital assets within days. This was just a shock to the economy, it was a collapse of the foundations of the global financial system. Millions of investors went bankrupt overnight. The economies of several nations were cut off from their financial lifelines. Banking systems broke down, and social order faced its most severe challenge in decades. The root of it all lay in long-standing structural risks buried within the global cryptocurrency market. Over the past decade, cryptocurrencies had drawn in billions of investors and massive capital flows, thanks to their decentralized nature and promise of high returns. New tokens sprouted like mushrooms after rain, and market enthusiasm soared as investor confidence reached euphoric levels. But in the absence of proper regulation and under a climate of rampant speculation, prices of digital assets became grossly detached from their actual value. More and more projects were exposed for fraud, money laundering, and market manipulation. The risks kept piling up. By March 2026, a chain reaction triggered a rapid and catastrophic collapse. It began with several major cryptocurrency exchanges revealing insolvency, unable to meet users' withdrawal demands. Panic ensued, and withdrawal requests overwhelmed systems, forcing shutdowns. Soon after, the top-valued digital currencies plummeted, losing over 70% of their value in just 48 hours. The crash spilled over into global financial markets. Funds and derivatives tied to digital assets took enormous losses, and numerous investment firms declared bankruptcy. The economic damage was swift and severe. Companies that had relied on crypto-backed assets collapsed en masse, wiping out millions of jobs. Personal wealth vanished overnight, pushing many families into bankruptcy and poverty. Banks, whose loans were backed by digital collateral, saw massive defaults. The breakdown in liquidity led to a widespread credit crunch, severely restricting traditional economic activity. Governments and regulators were caught off guard. Some countries announced emergency bans on crypto trading unrelated services to try and contain the panic, but the collapse spread faster than any intervention. Fear overtook global financial markets, stocks and bonds tumbled, while gold and other safe-haven assets surged. The global economy teetered on the edge of a deep recession. International trade contracted sharply, and supply chains suffered escalating disruptions. The societal impact was equally devastating. Massive unemployment and sudden wealth losses led to public protests and unrest, and law and order began to deteriorate. The role of cryptocurrency as an alternative form of money came under heavy scrutiny, and trust in the system collapsed. Digital innovation stalled, and the momentum of tech advancement was crippled. Globally, people began to question not only financial institutions, but also the blind faith in technological progress. Social divisions deepened. This catastrophic collapse exposed the fragility of the modern global economy and its overdependence on high-risk speculation. The fundamental mismatch between traditional financial systems and emerging digital assets triggered an unprecedented loss of trust and breakdown in capital flows. Both everyday investors and sovereign financial institutions suffered crippling losses in the storm. Though governments began joint emergency responses, rolling out stimulus packages and financial reforms, the total collapse of the cryptocurrency market had already become irreversible. A global economic reset had quietly begun, with new rules and orders desperately needed. The aftershocks of the crypto collapse continued to ripple through every corner of the global economy. As trillions in value were wiped out, financial institutions were forced to reevaluate their risk management strategies. Traditional banking systems, now under immense pressure, accelerated their pace of restructuring and consolidation. Countless loans backed by digital assets defaulted, freezing the credit market and cutting off corporate financing. Emerging economies that had relied on crypto for remittances and payments had to revert to traditional financial systems, bearing immense transition costs. At the national level, governments and regulators finally recognized the disastrous consequences of previous regulatory gaps. Global financial regulatory cooperation intensified. Multiple countries began drafting unified regulations for digital assets, placing strict controls on high-risk crypto products. At the same time, the development and rollout of central bank digital currencies, CBDCs, accelerated. These state-backed digital currencies became a crucial tool to restore trust and stabilize monetary systems. Nations aimed to replace privately issued digital assets with sovereign-backed alternatives to re-establish stability. This led to a profound transformation of socioeconomic structures. Mass unemployment overwhelmed social welfare systems. Wealth inequality widened further, fueling public discontent and social tensions. Blind trust in financial technology was shattered. Investors became more cautious and risk-averse. The once-thriving atmosphere for innovation cooled, and capital shifted towards safer, more traditional sectors. Crypto-related industries shrank, tech talent fled, and the growth of the digital economy slowed significantly. Yet within the shadow of this crisis lay the seeds of new opportunity. Some nations used the turmoil as a catalyst to restructure their economies and upgrade their industrial foundations, doubling down on real economic output. Blockchain technology was evaluated not as a speculative tool, but for practical and compliant applications. Fintech firms pivoted toward integrating with regulation, seeking sustainable development models. Global investors focused more on diversified portfolios and risk mitigation, encouraging a more mature and rational financial market. The global financial reset will not happen overnight. The cryptocurrency crash revealed the systemic risks embedded in global economic interdependence and highlighted the glaring disconnect between technological innovation and regulatory oversight. Future economic systems will prioritize transparency, compliance, and risk management. Financial innovation will move forward more cautiously and responsibly. International cooperation will become the new norm in managing cross-border financial risks. This collapse stands as one of the most defining financial events of the early 21st century, reshaping the economic, political, and cultural landscape of human society. The bursting of the cryptocurrency bubble didn't just bring an era of speculative frenzy to an end, it marked the beginning of a new chapter in global economic governance. The path ahead is filled with challenges, but also with potential. Humanity must learn from this catastrophe and build a more resilient, equitable, and sustainable economic system to meet the true future of the digital age.